I've only known you now for what, 5, 6 years? 6, 7 years? Yeah. And I don't know the name of your company. But you know, it's easy to do, right? So I mean, when you say it, yeah, exactly. So John has become a buddy, but this guy want to know about a photographic memory. It's actually scary. So he can remember everything. So I'm surprised you actually don't remember the date that we met. Actually, you probably do. Yeah, maybe you do. So I shouldn't.
I could make one up.
Yeah. John has done all of the lease-to-own underwriting for us when we had our first fund, which is ROI Strategies, the very first one, which we still have. We're just not taking money into it for all of those. And there must have been at least 100 that you did for us, right? Somewhere in there, right? And so what John would do, and he was very smart about this, he knew he wasn't going to make $1 the day that he was doing the underwriting for us. But he knew down the road those people were going to go and get financing. And so you knew that it was going to be 1 year to 3 years probably somewhere out there, and you put all that together. And I can't tell you, before even meeting you and getting that chance to do that, there's so many other mortgage brokers that just couldn't get that figured out. They had to have $1 today. Yeah. That's what they had to have. So anyways, that's how we got to know each other. And then we started talking reverse mortgages, and we ended up doing a podcast on this. And we just said, you know what, this is something that people need to know about. And so I know that, you know, maybe most of the people in this room, maybe who don't even need a reverse mortgage here tonight, but you know somebody out there that probably does. And so now you're going to be empowered to be able to take that and tell them about it. So let's welcome John to the stage, and we'll do it.
Thank you.
So we're not going to stand the whole time. We can sit. This is a nice little interview process. We got lights. It's very official, kind of like movie stars up here, right?
Definitely.
So why don't you just tell us a little bit more about what you do? I gave you a little bit of an introduction there, but and we'll take it from there.
So CTC Financial is a mortgage broker, so we are mortgage brokers. And I say we, so right now I'll have Michelle raise her hand. Michelle also works at CTC Financial with me, and is also my girlfriend. Yeah, I know. We do mortgages on single-family homes, duplexes, 3 units and 4 unit properties. We do purchase loans, we do refinance loans, we do reverse mortgages, but everything we do, we specialize in 1 to 4 family dwellings, and manufactured homes fall into that. We do manufactured home loans. I've gained a reputation in Carson City for being the king of manufactured homes. Because I'm a mortgage broker, I can find lenders that will do all of the difficult loans on the manufactured homes. So we basically purchase, refinance home loans.
Yeah, and what you'll find with John is he's a super thinker. So when he needs to get creative, figure out how you can work certain things out, and especially even from a business standpoint. So for us that are self-employed, you completely get that, and you understand that completely in the manner of what does it take to get there. You end up doing my mortgage when we refied mine. I think you did Steve's too, right?
I did. Yeah.
So yep. So on that. So if you are looking from that standpoint, you know, John or Michelle, Michelle's a little bit better looking. If you want to go to somebody that's kind of cute, but go to Michelle. But either one of them are great people, and we'd love to have you guys here. So great. All right. Well, let's talk reverse mortgages. Okay. So there's a lot of myths and everything out there, but before we get there, and there's a lot of negativity about them, right? Why don't we just talk about what the heck is a reverse mortgage? How does it work? Give us a basis.
It's very simple. A reverse mortgage is a loan that you do not have to make payments on. And in order to get the loan, you have to be at least 62 years old, and you have to be a homeowner. It's that simple, but it's not, because there's an underwriting process. But that is in the simplest form. It is a loan that you do not have to make payments on.
Okay. So one thing that I learned as we've gone through all of this, and I'm just going to say this up front because it might help everybody out there to get it in their head. it really becomes a line of credit because you can actually get the loan, you can use X amount of the loan, you can pay back the loan, you can retake it back out again. You can do that. Now that doesn't always happen, but that's the way that it sort of ends up working from that standpoint. So let's take the next step. What's the next step? So somebody comes to you and we'll pick an age or whatever. Let's kind of talk it through and how that works.
Before we do that,
okay,
since the topic is what are the 3 myths of a reverse mortgage, I figure we should answer that first.
Okay.
So I want to answer what those 3 myths are. One of them is that they have a high default rate, which means you get foreclosed on. Another one of the myths is that they are, if you're married and your spouse dies, the remaining spouse can get thrown out of the house. And another one of the myths would be that they are very expensive to get. Mm-hmm. So as I go forward and explain the reverse mortgage, you'll see that I'll address those myths. But just so that we can answer the question, why do those myths exist? Typical mortgages, forward mortgages, your traditional mortgage that you get to qualify for and you make a house payment, they have delinquency rates of maybe 2 to 3%, 1.5%, depends on the economic times. By the year 2013, reverse mortgages had 10% default rates. So clearly they were 4 times more likely to default. The reason behind those default rates was because when the program originally started in 1988, the only thing you needed to do to get a reverse mortgage was own the house and be 62. They would give one to anybody, and you found that people would get them and then not be responsible with their house, and what they wouldn't do is pay their taxes and insurance. And they would not pay them for 3, 4, 5 years at a time. And then what was happening, that's the biggest reason for defaults on reverse mortgages. So what would happen is over time, the city would file the tax lien and force the tax sale. The lender would have to pay the taxes to satisfy that so they wouldn't lose their loan. They wouldn't lose their position or their right to foreclose on the home. And then they tried to work out with the borrowers some kind of workout or solution, and HUD stepped in and said you can't do that. So the actual federal government program that was designed to help people over 62 have an alternative source of cash then came along. It was kind of like a mafia situation. We're going to give you this money. Boy, if you don't pay us, though, we're going to knock your door down and we're going to beat you up. And so the HUD actually forced the lenders who were servicing those loans to foreclose on the people. They didn't want workouts. They didn't want to extend the problem. They wanted people foreclosed on, or they actually threatened to take the mortgage insurance away from the servicers. So lenders were under pressure from the federal government to foreclose. I don't know why. It would be something that I would love to have somebody explain to me at HUD. But this goes back to legislation that was 20 years old at the time, and then it was about 10, 12, 15 years ago that they were forcing the lenders to do this. So that's one of the reasons why you saw the defaults. Another reason,
which has nothing to do with the reverse mortgage.
Has nothing to do with the reverse mortgage.
They just happen to have it in ancillary. They lost it through not paying taxes, etc.
Mm-hmm. People just didn't for whatever reason.
Right. But that doesn't change. I mean, that has nothing to do with a reverse mortgage. I mean, it just so happens they have it. That's it.
Right.
I mean, that's a really important point on that.
And reverse mortgages used to be, if you were married and you got the reverse mortgage in your name only because, say, you were 62 and your spouse was 58, so you left your spouse off the loan. You're 62, you get the reverse mortgage. 5 years goes by, you die, your spouse had to cough up the money or sell the house or get foreclosed on. And so if the spouse refused, if the spouse couldn't qualify to refinance, didn't have the cash, couldn't sell the house because maybe it was upside down, because there has been a couple of economic cycles that we all know have brought property prices below loan amounts. So those spouses were being forced out of the house. They were being foreclosed on and forced out of the house.
And that was mainly because they're not on the
loan. They weren't not on the loan.
So even though it's 5 years and they're now 63 years old, the spouse, that didn't have anything to do with it. They simply weren't on the loan.
Correct. It wasn't their loan. They had to cough up the money. They couldn't. They were forced out. More mafia tactics by the part of HUD. And the other thing was reverse mortgages used to be very expensive. And they cost $25,000, $22,000 when a typical home loan would cost $4,000 to get one. So those were the three issues, and they have all been addressed with changes to the program that started taking effect since 2013.
Still more expensive than a conventional loan in doing that, but and we'll maybe talk a little bit about that, but they're not near as what, you know, and what did you tell me at the beginning tonight, that on which website
okay,
was
so
it?
there's a Consumer Finance Protection Bureau. It was created, I don't know how many years ago, I want to say 7 years ago. It was created to supervise lenders. It was to be the lender's watchdog. It was to be an entity that would truly have the consumer's best interest in mind and keep all lenders honest. And in the process, they restricted fees that we could make on a loan. They actually came in and capped what we can make at 3%, which is kind of comical because before they did that, we were lucky to get 1.5%. And that doesn't mean you pay 1.5% in fees. It just means that there can be income generated on the sale of a loan. On the back side of the loan that the consumer doesn't pay, you can get a no points loan. Your lender can put them together, sell them on the secondary market, and get 2 or 3% on the back side for those loans. So it's not the consumer paying those fees, but what happened was the Consumer Finance Protection Bureau decided that 3% was the most everybody could make. So they capped us all. So now you have a very homogeneous interest rate market where everybody's really close because you have to pick your fee, set it, and stick to it. So you can't give different deals to different people. So they have on their website, the Consumer Finance Protection Bureau, I just read this last night, I was snooping around on there, and they claim that the average reverse mortgage costs $39,000 to get, which is not true.
Way more.
It's not true.
What would you say? Is there? And there's probably no way to average.
So I had 2 people in my office yesterday. I had an appointment with them. I explained the whole process to them, and their closing costs would be $15,700, which is still not cheap, but it's not $39,000. They're $15,600 on it was a $224,000 loan amount. Now, if that's a forward mortgage and you're refinancing on a $224,000 loan, you're looking at about $1,900 to $2,200 in fees, escrow fees, title fees, appraisal, credit report. On a reverse mortgage, you have escrow fees, title fees, appraisal, credit report, but then lenders are allowed to charge an origination fee, and FHA charges a 2% mortgage insurance. And the 2% mortgage insurance is paid on the appraised value of the home, not the loan they give you.
Oh, wow.
So the people that were in my office yesterday had a $630,000 estimate of the value of their home. 2%, $12,600 just for the mortgage insurance. And that, by the way,
thank you, government, for
that, by the way, changed on October 2nd. It changed, 2 weeks ago on October 2nd. And it used to be 0.5%. Now it jumped to 2% because the FHA is concerned. They have actuarial studies. They're concerned about the liquidity that they have in their mortgage insurance fund if they have to pay out on defaults. They want to make sure they have enough money, and the program is not supposed to cost the taxpayers any money. So they did a study and decided they need to bump it to 2%. It also creates a deterrent for a lot of people because it's expensive.
Right.
And then, so these people had $15,600, $15,700 in fees. It was the mortgage insurance. The other $3,000 was escrow, title, appraisal, and recording fees. So it's the mortgage insurance has made them expensive. So they are 4 times as much as a forward mortgage for the fees, but it's mostly HUD's mortgage insurance. And when they give you the loan, you don't write a check for that. When you get a reverse mortgage, to the extent that you have enough equity in your home and you're not paying off your current mortgage, those fees come off the mortgage. So the people that were getting $224 yesterday, those $15,000 or $16,000 come off the top, leaving them with $208. And then they pay off, their mortgage was like $196, and they were going to be able to put like $8,000 in their pocket and eliminate their mortgage and never have a mortgage payment again for the rest of their lives, as long as they stay in the house.
Okay, so let's just go that's the next step. So In that case, they've got the $8,000. They never have to make a payment. As long as they stay in that house, they never make another payment.
They don't have
That's
to.
their choice.
It's their choice.
That's their choice.
They can if they want to,
Right.
but they do not have to.
So now what happens is it continues to build, though, because if they're not making the payment, it's sort of like a negative amortization.
It's exactly
Is
like
that
a
right?
negative amortization loan.
Okay.
And that is another word that is viewed negatively, and actually
people don't understand it, or?
was because people don't understand them, and they were misused, just like reverse mortgages were misused back in the days of the Wild West, before there was more regulation from the Consumer Finance Protection Bureau. And the Wild West in the mortgage industry was only about 8 or 9 years ago. And which is all of those freewheeling open guidelines are what contributed to the mortgage meltdown. It's one part of it.
Mm-hmm.
So the reverse mortgages, for example, one of the things I mentioned about the defaults with the non-borrowing spouse not being able to keep the house, they addressed that in 2012, and they came out with a ruling: if you're 62 and your spouse is 58, as long as you're married at the time you get the reverse mortgage, and you disclose that you're married, and your spouse attends the same counseling that you attend, there's mandatory counseling, it's like 90 minutes, you can do it by the phone, you can do it in person, and you have to include your spouse has to be included in the loan paperwork, only being named as the spouse. They don't go on the loan. The reason people do that is if you're 62, you can get a reverse mortgage. If you're 58, you can't. So if the two of you apply together, the 58-year-old stops you from being able to get the loan. So some people will say, can we leave her off or him off? Sure you can. You can leave him off because he's 58 and you're 62. We'll do the loan in your name only. Now they have a protection. If that person who got the loan in their name only, now they die 5 years from now, the non-borrowing spouse, which is what we call them, the non-borrowing spouse gets to stay in the home. However, there's one little thing that I wasn't aware of until I was snooping around last night. You have to send in a certification. You, the borrower who got the loan, has to once a year fill out a form, it's a certification, and send it to the lender servicing the loan and let them know that you're still married. And if you fail to do that, your spouse is going to have a huge problem. But I've also seen that they have an appeal process for that, and it sounds like you can get around it if you forgot to do it.
Because not everybody probably remembers.
Because not everybody's going to remember, and it's like, here comes the mafia again.
Yeah.
It's like, it's FHA, for Christ's sakes. It's the federal government. And it's like, you're supposed to be protecting the people, and you stick these little things in there. And it's like, who does that?
Right.
And so you can, so now you're not going to have the non-borrowing spouse get foreclosed on. Mm-hmm. That's going to pretty much disappear. Mm-hmm. And the only other thing I mentioned on the myth, I want to say this before I forget, the taxes and insurance was the biggest single reason why people were getting foreclosed on. And what they're doing now is if you apply for a reverse mortgage, statistics or actuarial studies have shown that the people who don't pay their taxes and insurance were the ones who traditionally had poor credit, and their credit reports were pulled when they got a reverse mortgage. They were only pulled, though, to make sure they didn't have outstanding federal debt, or like, let's say, an outstanding federal tax lien or an outstanding student loan, because that would make you ineligible for a reverse mortgage under the old rules and under the new rules. So a credit report was pulled to make sure you weren't in the middle of a bankruptcy, because a lender doesn't want to put a loan on your property in the middle of a bankruptcy, or you didn't have these past due federal debts. So you could see the credit reports in the file, and you could see if people didn't pay their bills. And the majority of those people were the people who got their loan and said, cool, and didn't pay their taxes and insurance. Mm-hmm. So what they've done now is when you get a reverse mortgage, we have to run your credit, and we have to get some income information from you. And we have what's called a financial assessment test, and it brings into play the income you make and your credit. And if your credit is not the best, and it's kind of a case by case, there's some broad guidelines on it. If your credit's not the best, or you've missed a tax payment in the last 12 months, or you paid your homeowner's insurance late, and you can make your tax payment late, not necessarily completely miss it, but if you make it late, pay a penalty. What it does is it triggers a set aside. The lender has to figure out what your property tax is, and insurance are? Well, they know. They get your tax bill and your insurance bill. They add it up for the year, multiply it by 12. So if your taxes and insurance are $300 a month, then that's $3,600 a year, and they hold, I'm sorry, yeah, that's $3,600 a year, and they take 12 years worth of that and put it in an account. So what is that? 36,000. It's about 43,200 bucks. They'll take it off the top of your reverse mortgage and they'll stick it in an account, and it'll function like an impound account does on a forward mortgage, and the lender will pay your taxes and insurance 12 years out.
So if you've got bad credit, you're going to have a pretty tough time then, because that's a big chunk of money to come out.
Right, and that rule came into play in 2015, and they don't have a lot of data on it, but the defaults that are now associated with taxes and insurance are down to 0.6%. But they only have about a year and 4 months of data to collect from people having gotten those in April 2015.
Yeah, they're going to need quite a bit more
Right.
on that. Okay, so let's get back to, there's a lot of layers in here.
There's a ton of layers.
Different things, but let's just, on just the simple deal is, let's go back to those people that got $8,000 in their pocket. Let's say they didn't take the $8,000. They left that in there. They would have $8,000 to draw upon later.
Correct.
Right? Okay.
For the first 12 months.
Okay, now let's just make up a number, or maybe you know. What would have been their payment if they decide to make a payment? Just
on the reverse
so it
mortgage?
becomes not a negative amortization.
Well, the interest rate is in there on their loan was 4.53. So 4.53 would be $4,530 per 100,000. So 9,060 plus another 20%, maybe about maybe 10,500 bucks. So what is that? About
For a total of the year?
About $900 a month in interest.
So if they decide to make a payment of $900 a year, a month, is it correct to say that if they were doing that, then they're basically keeping it at an even balance?
Correct.
They would. So if they had that $8,000 there to draw upon, they could still draw upon that later if they decided to make the $900. If they don't, each month it continues to draw down on that $8,000. Is that correct?
Correct.
Okay, so let's say that they don't. That's what they've chosen to do. They've now exhausted that after X amount of months on that deal. Now what? So now they still don't have to make a payment.
They still don't have to make a payment.
But they start to go into negative.
At the end of year one, they get a 4.5% increase on this line of credit, because as you said, a reverse mortgage there is a fixed rate reverse mortgage.
On the total amount, they're going to get a 4.5% total?
Yeah, something like only 2% of the people get it, the fixed rate loan. They give you a lot more benefits, and it's a little less expensive to get the adjustable. But they base it on that original 224, and they'll give you 4.5%.
So they're going to take 4.5% on the 224,
which is about $11,000.
and you have that much more credit to pull upon.
Now you have another 11.
Okay.
And that continues the life of the reverse mortgage.
Okay.
So not only are you piling interest on top of the original loan amount, but you can pile additional draws on top of it.
Okay.
And if you do that, at the end of 30 years, you will owe $2.2 million, and the house is projected to be worth $1.5 million. So if you get one at 62 when you're 92, by the way, you don't have to pay the loan off, but they give you an amortization schedule and you have to sign it because they want you to see those horrible numbers. You will owe $2.2 million and your house will be worth $1.5 million by the projections that they give you on the loan application, because they have to tell you something and they don't know what your house is going to be, but they do know how much your loan will go up. So your house could be anywhere. It could stay the same. If you're 92 and you get to that point, you can keep the loan till you die. It just keeps going. But if you wanted to move at that point, you'd be upside down. So if you're 92 and it's time for assisted living and you move out of the house and the house has to be sold, well, clearly if you owe 2.2 and it's worth 1.5, you are upside down. You just walk away. And they take the house and there's no recourse to you. None whatsoever, no recourse at all.
Do you know how those numbers work for those 30 years? If you started at well, I don't know. Are we at the 224 still?
This was the same people.
This
They had
is
a
the same
224
people.
loan,
So would
and
they-
it grew to 2.2 million in 30 years.
Okay, but that's interest and everything else.
Just everything getting added on. They
Right,
never paid a
right.
dime.
But again, I guess if they're not paying a payment, then for those periods of time, all they're doing is adding that on. So they only got their initial amount is what they ended up doing.
Right.
And so
Or
it sounds like
perhaps-
it's a little bit of a wash.
Or perhaps
Yeah.
they also used the 11,000 each year, the additional that they got. Which
Oh,
if somebody
sure.
was
So-
using it for income is about $900 a month.
So you can once you get that, you could go take the 11,000 out.
Mm-hmm.
That piles on an additional amount of interest because you have now a new credit balance.
Which is how they
Of that.
calculated the 2.2 million.
Right,
They assumed
okay.
you would make no payments and pull the money
And pull the
additional
money out.
money every year.
So you would be able to pull out then another whatever that might be $350,000 or so
Over a
30-year
30-year
period.
term.
Yeah.
Right.
Okay. But roughly, it sounds like you'd end up getting a value of about $500,000, maybe $600,000, and you would, at the end you'd be upside down. But you would have gotten that value of dollars,
Sure.
real dollars,
Right.
on that deal. Yeah.
See, and that's just
And
another
I know
thing.
you guys might have some questions out there. Probably let us get through all this. I mean, not that anybody's, but I know there's probably some things going through that, and then we will answer questions here at the end.
Well, this
because
is a
there's lot
perfect
to
time
this.
because everybody's sitting there going, "Who the hell would get one of these?" And I know
Well, no,
that.
but I mean,
And I know that Stephanie said, who I was talking to earlier, said she's heard nothing but bad things about them, and I feel like all I've done is said bad things about them.
yeah, but that's not bad.
But there's- but that's not-
If for 30 years I got
Right.
to pull $600,000 worth out, and then I just got to walk away because it doesn't matter. I could owe $10 million on the house.
Right.
Who cares?
Yeah, who cares?
I got a certain amount out of that, in
Right.
that respect. Now that may not be 100% the best use or the way to manage your money. That's a whole different thing. But what it reminds me of is when we were talking too, is that these things cost more, right? So when we do mortgages in the Midwest, we charge 12%. And sometimes people go, my gosh, how could you possibly charge 12% for these people? You're just ripping them off. Well, we're not. We're actually giving them an opportunity. We set it up so that they're going to be successful. They have the ability to pay. In order for us to attract investors in, we have to be able to pay our investors a certain amount of money. All these things work within the free market, right? And so you look at the whole picture, and again, it comes back to a reverse mortgage. If that's the right thing for me to do, not always going to be the right thing to do, and I have to pay $15,000 in fees by the time I'm done, it's the way to go, right? So,
Right.
yeah, I mean, it's not, you can't look at all those things as being bad. Sometimes it's the right way to go. Paying 12% on a mortgage in the Midwest works out for those people. They're able to become homeowners. They're able to do it for the same price they could at rent. So it's very similar in the same ways that you're looking at.
And let me tell you why they're good to do.
Yes. Okay.
So, let me give you a real life example. 85-year-old woman lives by herself, lives off of note income from the sale of a property. She carried paper. The payment was $1,500 a month. Her Social Security
This is a note that she owns.
She owned a note because she sold a building.
Okay.
So the note income was $1,500 a month, but someday the note gets paid back and there's no more $1,500, and that was coming at the age of 85. She was getting $1,300 in Social Security, and she only had $55,000 in her IRA. She's 85 years old. So she's making, what is that? That's $1,500, $1,300 is $2,800, about $4,000 a month. The note income's gonna stop in about 3 months. She's panicking, like literally getting sick, crying, and worried. And the kids are on the phone talking to each other going, I think we're gonna have to send mom $200 a month each or whatever we can afford, because mom's living expenses are $3,200, okay? So mom's gonna lose $1,500 income, she's gonna be upside down, $700. So let's get rid of the magazine subscriptions, let's stop buying the kids $100 birthday presents, et cetera, et cetera. Okay, now we got it down to about $2,900, $2,800. Mom is still upside down. How about a reverse mortgage? What does the reverse mortgage do? Pays off the mortgage. Mom had a $850 mortgage payment. And she had $126,000 balance, and she still had quite a few years left on it, like 15 years to go. So let's get a reverse mortgage. So she got a reverse mortgage, and she got one for $175,000. She paid off the $126,000 loan, completely eliminated her mortgage payment, which helped with that budget because it now brought mom down to a $2,000 a month monthly budget and an income from Social Security in that IRA of $2,500. So now mom's solvent and kids don't have to help mom. Everybody wins. Mom gets the reverse mortgage at $175, pays her loan off. It costs her 14 grand to get it. So she pays off $126, 14, put her at $140, and she took $35,000 and remodeled the house. She loved to cook. You figured out I'm talking about mom. She figured she loved to cook. Yeah. Well, I could be talking in the third person, but yeah. This is my mom. And so my mom got a reverse mortgage. And she was so happy after she got it. She was very nervous about it. She talked to her CPA about it. They talked to the financial planner that was managing the dwindling IRA. They both said, you should definitely do this. So she did it. Well, she passed away about 4 years after getting that reverse mortgage, and she owed $226,000. The house was worth $350,000. So my sister took the house. She bought the house, if you would, and my sister can't have the reverse mortgage anymore. So Wells Fargo was servicing the loan, so I called him and said, we're gonna pay the loan off. My sister's gonna take title to the house, bring cash in and get a $60,000 refinance. So we do a $60,000 loan, pay off the reverse mortgage, and my sister has the house. But the important part of the story is my mom, it was used in a very good way. This bad loan was used in a very good way to help my mom in a situation that was very real to her and making her very nervous. And I'm telling you, there were lots of phone calls, and it was very, very stressful. And I've seen now, since she having done that, I have seen that exact scenario duplicate itself as I do reverse mortgages. On the other side of the coin, I've had people come to me who have no loan on their house, and they're 72 years old, and they want a reverse mortgage. Why do they want a reverse mortgage? Because they want to buy a fatty motorhome. So they have a $400,000 house. They could have qualified for like a $200,000 reverse mortgage, but they got one for like $120,000, and they bought a motorhome. And they were like on my butt, because they found the motorhome before they started the loan with me, and the lady they were going to buy it from was threatening to sell it, and it's like, come on people, and it was like chomp chomp chomp, and the loan closed and they bought a motorhome. Okay, they could have financed the motorhome. They had 800 credit scores, but they wanted to do it with the reverse mortgage because they didn't want to have to make any payments, and they figured, let's just use the reverse mortgage, and then maybe this extra money will come in handy in case of an emergency. Another person came to me for a reverse mortgage who owned their home free and clear in their early 70s, and they simply wanted to get it now because they wanted to have it available to them in case of emergency. And the guy said, if we ever have an emergency, and he's right, we probably won't qualify for a loan because the emergency will either be an income issue or it'll jack up our credit. It'll be one of us gets cancer, and I don't want to go through a loan process and get denied. And even if I'm not going to get denied, I don't want the stress, I don't want the paperwork, I don't want to deal with it. So I'm going to get it now while I don't need it and I'm not in a hurry. And he got a reverse mortgage, and it cost him about, I want to say $13,000 or $14,000. So when the loan funded, the lender took the $14,000 for the fees, and he didn't take a nickel. And I don't know to this day if he's taken a nickel, but he simply got it to have it in case of an emergency. So you've got somebody who wants to get out of their mortgage payment. You've got somebody who wants to buy a motorhome, maybe remodel a house, and you have somebody who just wants one in case of emergency. Mm-hmm. Another thing that's becoming talked about a lot and starting to become popular is, I think we have something like 60,000 people a month retiring right now or turning 62. And the average person, 60% of them own their house, and something like another only another like 25% of them have more than like $50,000 in savings. So they're retiring and they are looking at Social Security. And you know, some of you probably get those Social Security letters that tell you how much you're going to get if you take it at 62, 66, or 70, whatever the numbers are. I got mine a couple months ago and I was playing around with it. If you put it off, mine went from like 17 to 2,500 to 3,200 if I put it off till I'm 70. So if you're in a situation where you're retiring and you don't retire with a lot of money, maybe you're only going to retire with $1,500 in Social Security and a $300 pension because you had a short time where you had a job that paid a pension. And I see this a lot when people call and want to try to refinance their house. I see people trying to do it with $1,200, $1,400, and $1,800 in income, and it's difficult to get them a loan. It's very difficult. It's almost impossible. So these people can take the reverse mortgage and get it today at 62, and they can not draw on the Social Security. They can let it ride till they're 70 and get the higher amount and use the reverse mortgage, this line of credit. They don't have to take all the money at the closing of their loan. They can take $1,000 a month. Every month they can take $1,000 and supplement that $900 of Social Security and the $300 pension, and on $2,200 a month, they can live somewhere. They can also use the reverse mortgage to purchase a home and not have a payment. So somebody with a $1,800 or $2,000 income could actually buy maybe a $250,000 house using the reverse mortgage. They would have to have a down payment, but they could use a reverse mortgage for that reason. So it's a way that you can put off drawing from your retirement. Right now, stock market's been booming. A lot of people I know who park their money with financial planners, you know, they complain about them when the market's down because the financial planners just let them go down with the market. A lot of them do, and no offense if anybody's a financial planner, but a lot of them just simply put your money in a mutual fund and it sits there. And I went through this, and it goes down, and then the market comes back and it goes up. So if you're riding it up and you're recovering, or you've got a financial planner who's got some good ideas and is beating the market, then you may not want to pull your money out, so you get a reverse mortgage. Yeah, it's going to cost you 14 grand. If you own your house free and clear, you might have a $150,000 line of credit. You can use that for the next 4, 5, 6, 7 years, 2 years, 3 years. You can use it and postpone taking the money out of your mutual funds or your IRAs. And again, you can use it to postpone a pension if that's possible, and you can use it to postpone Social Security income. So these are all reasons why people get reverse mortgages. And if you go to the Consumer Finance Protection Bureau's website, they will give you all the reasons why you shouldn't do that. And when you go to the counseling for the reverse mortgage, they talk about what's bad and what's good. So it's just like a lot of other situations. You shared with me beforehand that you were at Sears and he made a purchase, I guess over the weekend, and they said, you should get our credit card. And he said, I don't want another credit card. And they said, we'll give you $200 off the purchase. So he filled out the credit card. They immediately approve him. It spits out the cash register 2 minutes later. And he looked and saw that if he ever has a balance, the interest rate is 29%. Well, nobody's screaming about that. I have a Capital One Venture. Yeah, and I have a Capital One Venture card, the What's in Your Wallet commercial, and if you don't pay every month in full, the interest rate is 21%. So everything that you look at financially, you can find a negative side to it, you can find a positive side to it. So you have
it depends whether it fits for
you really do have 4 major positive aspects, 4 major positive uses for a reverse mortgage.
So you're a very hard person to interview because it's just like I got to pull it out of you. So you know,
very quiet. You're lucky I'm sitting down.
I know. That's why we're doing this sitting down. Yeah. So you know, I think it was Doug, when we were talking earlier, Doug had said he thought, you know, before he knew about reverse mortgages, was that you always lost the house. And now that's perfectly clear. You don't. When you talked about your mom, as long as there's equity left in there and you can go out there and get it refinanced or buy the home to take it over, because you can't take the reverse mortgage, you don't lose the home. And I think that was one of the big myths that were out there. The other is, we talked about it right at the very beginning, I hope everybody's picked up on this, it truly is a line of credit. So the guy that took it out, never took $1 out, he has that line of credit sitting there. He can go out and do something with it. He can then decide either to make payments on it, not make payments on it. If he doesn't make payments, I guess, amortizes along on a negative amortization is the way to say it. And then he can also pay it off and have it still sitting there. And that goes on forever as long as he lives in that home for the rest of his, till he leaves the home, right?
It goes on forever.
Now, one of the other questions that we had in that same vein is what happens if Louis, I think maybe you live in Mexico for part of the year, right? So what happens if Louis lives in Mexico for 6 months out of the year, but his primary residence is here in Reno, whatever.
Okay, as long as it's your primary residence and you are living there, then you can have the reverse mortgage. If you go vacation in Mexico, it doesn't matter. If you go on, somebody could go on so many vacations that they're literally gone from their house.
It
6 months a year,
matter.
lucky them.
Yeah.
And that doesn't matter.
Okay.
But if you turn it into a vacation home and you're not permanently living there, then you cannot have the reverse mortgage anymore.
Right.
And they find out. They phone call, they check to see where your bills are. They check to see if you move your tax bill. They look at your insurance. They know what your insurance is because they get your insurance policy every year. So if you turn the house into a rental and you tell the insurance company they're going to give you a landlord protector policy, you're going to get caught. But I mean, they're following those things more closely than they would a forward mortgage. And I don't know how they do it, but they find out you move out of your house and then they say you have to pay.
Okay.
So it has to be your primary residence, but you can travel all you want.
But you can travel all you want. Okay. And then you didn't mention, and it doesn't sound like it, that there's no age limit. If I'm 62 and my wife is 40, then, because my wife's not going to age at all, and she's 40 and I wanted to get it, then could I do that? And she would be fine. Doesn't matter whether she's 40 or 25 or whatever.
Right.
Yeah. Okay.
Yeah, and you could have it for 30 years.
Yeah.
And she would be 70, you could pass away and she still gets to stay there and still gets it.
Yeah, and the same thing if I get it at 62 and I live to 102, that doesn't matter either.
Correct.
Yeah, all it's doing is just building on itself.
Correct.
At that point. And then she could take it over if she's younger or she's still alive and not to have to be in a Hewberry.
Right.
The assisted
living.
Senior assisted living. Okay, good. Good. What have we not covered on all of that before we start to take some questions? You want to look at your notes?
We can
and
just
make
take
sure?
questions.
Okay.
Let me just see real quick if there was something that should be said that wasn't said.
Okay.
No. We can take questions.
We have questions.
We're going to pretend that I have a house that's worth $500,000.
Okay.
It's not. Or we're going to pretend I own it free and clear. I don't. But if I did, and we're going to pretend that I'm 62. So I can go, can I get like an 80% loan to value, 90%? How much
Good
can I
question.
borrow?
Yeah, that's a
talk
good
about
question,
that,
and I actually wrote a note to myself not to forget to say that. So thank you.
Yeah.
Because I wasn't going to start looking. Okay, if this isn't the way that HUD calculates it, but it's very close. I am finding that you take your age and you subtract 20, 19 to 21, so 20, and that's the loan to value you get. So if you're 62 and you're going to get a reverse mortgage, you're going to get about 42% loan to value. So you're going to get about $42,000 per 100,000. And unfortunately, on October 2nd, when they changed the mortgage insurance from 0.5% to 2%, they changed that table, that factor. And it used to be that I could ballpark your age minus 10 or 11. Now it's your age minus 20. So it's going to be more difficult to make it work for somebody who owes $150,000 on a $200,000 house. They would only be able to get, if they were 62 years old, they would only be able to get on a $200,000 value about $85,000. And
But if you owe $150,000,
if you owe $150,000, you'd have to bring cash in. You'd have to bring $65,000 in to get rid of your mortgage, which you're allowed to do.
Yeah. Yeah, the loan to value doesn't change on whether you owe or don't owe on that. Okay.
Right. They have a formula that's not exactly your age minus 20, but I tested it and it comes out to that.
Pretty close. Okay. All right, Steve.
I actually have a few questions.
Okay.
The first is an observation. I was driving behind those people the other day that bought that motorhome, and on the back they had a bumper sticker You said we're spending our children's inheritance.
Yes.
Now, Greg has one, and his bumper sticker says recuperating workaholic. But, so my first question is, and this is just out of curiosity, you said that if somebody is 62 and they have student loans, it disqualifies them.
Past due student loans that are in default.
Does very much of the population still have student loans at 62?
Yeah.
Would they go to college late in life? Or
Not a lot of people, but I had a client that had $125,000 of student loans because of the University of Phoenix. Not that they're bad, they're just expensive. And she did this in her 40s and into her early 50s, and became it allowed her to get a really good job that she made over $100,000 a year on. And so she did it midlife and has these student loans, and they're going to take a while to pay. But if she didn't pay them, let's say at 52 she finishes, got this master's degree, gets this killer job, and decides not to pay her student loans, by the time she's 62, they will be well into default if she stops paying on them. So you could see it, but it's
only
not
default,
a large
right?
portion.
Only default.
You'd have to be in default.
Yeah, so as long as she's paying on
Right.
it, that doesn't exclude her from getting it.
What you're more likely to see are people who have federal tax liens, past due tax liens that they're not paying on with the IRS.
So my next question was, you said that if somebody goes into default because of not paying the taxes or being paying the taxes, and this big impound account is created, how does that affect the interest? Are they being charged on interest because they never actually hold the money?
Yes, they are.
Push.
Yep.
So it's a really huge penalty.
So you get your $200,000 loan, and they take $36,000 out. You got the $200,000 loan. You're getting the compounded interest on that.
Wow.
And the lenders.
Generated on the income on the impound account itself, though, to offset that.
There's impound accounts probably pay 0.1% interest. So you're going to be behind on that.
Okay. And the last thing that I wasn't totally clear on. So let's say that the person who gets the loan is 62, and they have a younger spouse at say 55. At 63, they pass away. Now that younger spouse is not 62, so if they're under the age limit, they don't call the note, right?
They get to keep the loan.
They do get to keep it.
They did not used to, but they get to keep the loan now, since 2013.
All right, I'm out of questions, I'm sorry.
That's okay. And
Could
this
you invest
question,
those impound accounts in Guardian and make more money on them?
No.
Oh, shoot.
the lender holds those.
Okay.
Speaking of Guardian, another reason why people could use a reverse mortgage, the interest rate is 4.53%.
It's what we did not talk about.
If
Yeah.
you know that you can make 10, 11, 12% on your money, and you get a reverse mortgage and you make 10% on your money, you're going to be ahead about 5%. And you could take your money out every month on that 10% you're getting, pay the mortgage, keep it level, and pocket the difference. So if you have investments available to you that would exceed that interest rate, and you also have to factor in the $14,000, $15,000 it costs, but if you had an investment you could make that would exceed the interest rate on a reverse mortgage, you certainly could use it for that. Now, when you go to the Consumer Finance Protection Bureau's website, there's a whole paragraph on why you should not do that. And I think you all know why you shouldn't do that, because there's no guarantee you're going to always get 10 or 11%.
Yep, that's for sure.
So the money that you're pulling out, it's tax-free, essentially.
Correct,
You're
it's a
pulling
loan.
equity out of your home.
Correct, it's tax-free, just like on a forward mortgage.
And then in regards to the brokerage, so say 100,000 is what you're qualified for, and whatever commission now is on that, say $10,000. That 10,000 that the broker gets is, the commission's taken up front, it's not spread out through.
This is how it works. HUD capped the commission on a reverse mortgage. The maximum loan origination fee is $6,000, okay?
Doesn't matter how much it is. Just
Yeah, that's the max, no
That's
matter
the
how
max.
much the loan is. But on a $100,000 loan, it's 2% plus $2,000, so it would be $4,000. Now, that loan origination fee is optional. So we don't charge it because what ends up happening is you do the math and the people are coming up short. So I always find myself going, okay, take this out so we can make the deal work. So after taking it out 4 or 5 times in a row, it's like, let's just always take it out. And reverse mortgages, actually, the people that came in to see me yesterday, they had literature from 4 other companies. And the guy asked a lot of really good questions, and I could see that he read the literature. And he asked me, do you have a loan origination fee? And I go, I took it out. Remember the first piece of paper I printed and we had? And I go, let me reprint it because I took that out and I reduced a couple things and I threw it away right after I printed it and I gave it to him. I go, I took it out. So he goes, is there anything else that's negotiable? I go, I just took $6,000 out. And he laughed and I go, there's really nothing. You're not going to negotiate with the appraiser. The title company's not going to negotiate the title insurance. The county recorder isn't going to negotiate their $28 recording fee. So I said, you're pretty much down to the bare bones. Unfortunately, it's the 2% mortgage insurance, the $12,600. It's killing you. And the only way to negotiate that is I call HUD and they're not going to negotiate.
So how do you make your money then?
How do I make my money? When the loan closes, it gets sold on the secondary market and it generates income, and that's how we get paid. So if we do a $200,000 mortgage and we do 5 of them, you put them together, this is very simplistic, and it's the same thing with forward mortgages because we don't have any fees on forward mortgages, and other lenders do this too. We don't have any fees on reverse or forward mortgages other than appraisal and credit, and those aren't our fees. They go to the appraiser and the company that runs the credit report. The loans are put together. There's $1 million worth of loans. They're sold on the secondary market, and the secondary market might pay $1,025,000 for those loans. So then we get the $25,000 for doing those 5 loans, $5,000 a loan. But the customer, nobody pays that. But that's how loans make money for banks, mortgage brokers, mortgage bankers. That's how Guild, Prime Lending, Summit Funding, Wells Fargo, Greater Nevada Credit Union, everybody does that. And that's how you get no points, no fee loans.
I see. Okay. All right, good. What other questions?
Hey, John, is there anybody else making money on that loan? I mean, if you're not taking that and there's a 2% origination, is there any other piece to it?
The servicing is, there's money in the servicing, just like there is in a forward mortgage. There's approximately 0.25% built into your interest rate to give to the company that services your loan. So so like on a 4 1/4 mortgage, 1/4 of that will go to the lender for servicing your mortgage, approximately. And that quarter is $250 on 100,000. So lenders have to service 20, 30, 40,000 loans to have an economy of scale so they can make that work. And they hope that 98% of the people pay on time so they don't spend a bunch of money on their collections department and go negative trying to collect their money. But that's part of it. And then on those loans get sold to investors, and a lot of times they get broken apart and they get different percentages. Just like when forward mortgages, when Fannie Mae buys those closed conventional loans, they want 3.5%. Whoever bought the loan and sold it on the secondary market, the bond trader, the mortgage-backed security trader, they got their quarter, the servicer gets their quarter. So Fannie Mae only gets about 3.39% on a 4 1/4 mortgage by the time they issue the bonds to buy those loans through 3 or 4 channels from the lenders.
All right. We good? Just give him a hand. All right. Well, thank you so much for coming. We hope everybody sticks around for a little bit, and obviously John will be here. Are you coming to the other InvestX too?
I should be at all of them.
So he should be here too. So if you have anybody that you think should come down and see us on the next ones, have them come down. If they're interested in mortgages or forward or reverse mortgages.
Forward or reverse.
Yes, I didn't know I had a forward one, but
going forward in reverse.
Okay, good.
Ozzy Osbourne.
All right, thanks. Oh, hey, wait, one last thing. I want to thank the team again. Sorry, I forget a lot of times, but everybody on putting this together, it takes a ton to put it together. So let's give those guys a hand. And thanks for doing it. All right.